Here's the brutal truth that will save your account. 87% of retail traders fail within 2 years. Most never make it back. They blow up one account, maybe two, then quietly disappear from the markets forever. And it's not because they're stupid, or unlucky, or because they picked the wrong stocks. They fail for a much simpler, more devastating reason. They walk straight past the same 4 red flags before every major loss. You've lived this nightmare. Picture the moment. You're sitting at your desk, the glow of multiple monitors reflecting in your eyes. You see a setup forming on your watch list. The chart looks perfect. Price is pushing higher. Volume is decent. And that voice in your head starts whispering that this is the one. This is the trade that makes your month. Your heart rate picks up slightly. The fear of missing out, that ancient psychological trigger, tightens its grip around your chest. The setup looks perfect. The chart whispers by. Your finger hovers over the mouse. You're not analyzing risk anymore. You're visualizing profit. You click. For a few minutes, you feel smart. You're in. You did it. Then, slowly at first, the price starts to slip. 5 cents. 20 cents. 0.5%. You tell yourself it's just normal pullback behavior. You've seen this before. Then the selling accelerates. The bid starts to thin out. Suddenly you're down 1%. 2. 3. Your stop isn't clear, so you give it room to breathe. Within hours, sometimes minutes, you're watching your position bleed red. You start bargaining with the market. If it just gets back to my entry, I'll get out. It doesn't. You close the trade, frustrated and confused. You stare at the chart and think, how did I miss that? It was so obvious. Then you say the 3 most dangerous words in trading. Bad luck again. The amateur blames luck. The professional doesn't believe in luck. The professional knows this trader walked past 4 clear red flags on their way to financial suicide. The loss didn't come from nowhere. It was earned, step by step, decision by decision. This reveals the fundamental identity divide between the 13% who survive and the 87% who donate their money to the market. Amateur traders look for reasons to enter. They operate from scarcity. They believe opportunities are rare and fleeting. They think if they don't take this trade right now, they'll miss out forever. They scan charts with confirmation bias, desperate to find patterns that justify putting money at risk. Cash feels like wasted opportunity. Professional traders look for reasons to stay out. They operate from abundance. They know the market opens tomorrow. There will be another setup next week, next month, next year. They've seen thousands of charts. They understand that missing one trade means nothing. Preserving capital means everything. Their default position is cash. Their default answer is no. They only engage when the market forces them to. You can hear this difference in how they talk. The amateur says, this could run huge. If I don't get in now, I'll miss it. The professional says, if this is real, it will still be there when the proof shows up. One is driven by fear of missing out, the other by fear of permanent loss. Jesse Livermore, the legendary boy plunger who made and lost multiple fortunes, learned this principle through devastating experience. In his early bucket shop days, he would take every trade that looked remotely promising. He was young, aggressive, confident. He made money initially because he had genuine talent for reading the tape. But that gift became a curse. It gave him false confidence. He thought he could trade his way out of any position. The market humbled him repeatedly. He went broke multiple times, not from lack of skill, but from lack of discipline. He would build a fortune through patient trading, then lose it all by abandoning his rules during periods of overconfidence or desperation. The cycle repeated until he finally understood that trading itself wasn't the edge. Waiting was the edge. He developed a system built on patience and confirmation. He would watch a stock for weeks, sometimes months, waiting for exact conditions. When those conditions appeared, he struck with size and conviction. When they didn't, he did nothing. He famously said the big money wasn't made in the trading. It was made in the waiting. After he learned to let the market come to him instead of chasing it, that's when he made his real money. Not quick wins that felt good, but evaporated. Generational wealth. That's where the red flag filter comes in. Think of it as your survival system. 4 non-negotiable warning signs that act as barriers between your impulse and your action. If even one red flag is present, you don't take the trade. Not smaller size. Not I'll just try it. You walk away. Period. I coached a trader once who had perfect back tests. When he sim traded his system, his equity curve climbed smoothly. But when he went live with real money, his results imploded. Same market, same patterns, same rules, completely different outcome. When we reviewed his trades, the problem was obvious. On almost every losing trade, at least one red flag was present. He wasn't following a filter, he was following his impulses. He had a justification engine, not a defense system. You might be in the same place. You know charts and indicators. You can name patterns and talk about risk-reward ratios. But if you're honest, your biggest losses never come from pure randomness. They come from ignoring something you felt but chose to dismiss. That slight discomfort when you're about to enter without a clear stop. That tiny voice saying the volume looks weak. That hesitation when you know you're trading because you're bored, not because the trade is there. Every professional trader has a moment they can point to where they realized the problem wasn't the market. It was their refusal to walk away when they should have. That realization is usually expensive. Some learn after a 10% drawdown. Some after 50%. Some only after their account hits zero. You don't have to pay that same tuition. Today you're going to learn these 4 red flags before the market teaches them to you the hard way. Each one is simple. None require advanced mathematics. But each is a survival mechanism that keeps you from stepping on landmines you can't afford to trigger. By the end of this video, you'll have a mental checklist that runs automatically before every trade, not written in a notebook you never open. Burned into your process. You see a chart, feel the urge to enter, and instantly your mind runs through, is this confirmed, or am I anticipating? Is volume backing this move, or is it hollow? Do I have a clear structural stop, or am I winging it? Am I emotionally neutral, or trying to fix a feeling? If that checklist becomes habit, it could save you hundreds of thousands of dollars over your career, not because it finds winning trades. Because it blocks the account killers, the ones that take you from down a bit to I don't want to open my platform. Here's the paradox you must accept. Most money you make in markets won't come from trades you take. It will come from trades you don't take. Every time you walk away from a trade with red flags, you're making a deposit into your future account balance. You're preserving capital for the next A+ setup. You're maintaining psychological equilibrium that lets you trade with clarity instead of desperation. Right now you're standing at a crossroads. You can continue hoping things will click, that you'll magically develop instinct to avoid bad trades. Or you can learn a systematic approach to filtering out setups that look attractive but carry hidden danger. You can build a checklist that removes emotion and ego from the equation. You can start trading like a professional instead of hoping like an amateur. The first red flag is the most seductive because it masquerades as opportunity. It makes you feel smart, early, and brave. It's responsible for more perfect entries that turn into immediate reversals than any other mistake. It's why most traders buy at exactly the wrong moment, convinced they're getting in ahead of the crowd, when they're actually volunteering to be the crowd's exit liquidity. Once you see this pattern, you'll never unsee it. You'll start noticing it on every time frame, in every market. You'll watch it trap traders over and over while you sit in cash, watching it play out like a scripted movie. And when you learn to step aside instead of stepping in, that's the moment you stop trading like an amateur and start thinking like a professional. Picture this in slow motion. A stock has been grinding sideways around, 48 for weeks, trapped between invisible walls. Every time it pushes toward 50, sellers step in and knock it back down. That level becomes etched in your mind like a battle line. You draw it on your chart. You watch it day after day, building a story in your head. Once it breaks, 50, it's gone. That's my shot. One morning, the stock opens strong at 49.20. Your pulse quickens as each green candle pushes higher. 49.40, 49.60, 49.75. You can feel this one building. The amateur's voice in your head starts whispering, if I wait for 50, I'll be late. The pros get in early, I'll sneak in at 49.75 and ride the breakout like a genius. You buy at 49.75, proud of being ahead of the crowd. For a moment, it feels perfect. The stock ticks up, 49.85, 49.95, 50.05, 50.10, you're in profit. You start calculating what you'll make if it runs to. 52. 54 maybe. 55. Then the tape shifts. The buying pauses. The bid starts thinning. Price ticks back to 49.95. Normal retest, you tell yourself. Then 49.50. Then 49.00. The selling accelerates. By the end of the day, you're staring at 47.80 on your screen. Your stop finally triggers the next morning at 47. You caught the breakout perfectly and still lost. This is red flag number 1, entering before confirmation. It destroys more trading accounts than almost any other mistake because it feels like the smart play. It masquerades as skill, as being proactive and strategic. In reality, you volunteered to be exit liquidity for professionals who saw you coming from miles away. The fundamental divide comes down to confirmation versus anticipation. The amateur anticipates what could happen. He projects his desires onto the chart, seeing breakouts before they're proven. He believes getting in at 49.75 is superior to entering at 51 because he gets a better price. The professional confirms what is happening. He knows that a better price on a losing trade is still a loss. He'd rather buy high and sell higher than buy low and sell lower. Here's why this distinction matters at a structural level. Markets are designed to trap the impatient. This isn't conspiracy theory, it's market mechanics. Market makers and institutional algorithms have access to order flow data that retail traders never see. They know exactly where amateur breakout buyers are positioned. They can see the cluster of buy-stop orders sitting just above 50, placed by traders who think they're being clever by automating their breakout entry. When that stock approaches 50, professionals often engineer what's called a stop hunt or liquidity grab. They push price just above that key level to trigger all those breakout orders and stop losses from short sellers. This creates a brief spike in volume and price that looks like genuine strength. Amateur traders see this spike and rush in, thinking the breakout is happening. But the institutions aren't buying at the breakout, they're selling into it. They're using the amateur's enthusiasm as their exit strategy. Once all the breakout orders are filled and there are no more eager buyers, the natural state of the market reasserts itself. Price collapses back below resistance. The breakout fails. The amateurs are trapped in losing positions while the professionals have already exited or gone short. You weren't trading against other retail hobbyists. You were trading against professionals with deeper pockets, better information, faster execution, and decades of experience. So what's the professional's protocol? How do you avoid being the sucker in this equation? It requires a complete rewiring of your instincts and the discipline to wait longer than feels comfortable. Step 1. When the stock breaks above 50, you do nothing. You sit on your hands and watch. A momentary spike means nothing. Buyers tried, but haven't proven they can hold control. Step 2. You wait for the session to close. Did it close above 50? If it closed at 49.85, the breakout failed. You were right to wait. If it closes at 50.20, that's your first piece of evidence. You still don't enter. Step 3. You wait for the stock to hold above 50 for at least one full session, preferably with volume significantly above the 20-day average. If it drops back below 50 intraday, the breakout remains unconfirmed. If it holds above 50 with strong volume, you're getting closer. Step 4. The true professional often waits for the break and retest. They want to see price run to 51, then pull back to test 50 as new support. They want to see that old ceiling become a new floor, with buyers stepping in to defend the level. Only after this complete confirmation process do you consider entry. Yes, you might pay 51 or 51.50 instead of 49.75. Your ego screams that you've missed the move. But what are you buying with that extra $1.75? You're buying probability. You're buying confirmation that the trend has actually changed. You're paying insurance premiums against false breakouts. Jesse Livermore learned this lesson through brutal experience in his bucket shop days. Despite being a tape-reading genius who could spot patterns before most traders noticed them, that gift became his curse. He would anticipate moves, enter early, and get shaken out before the real move happened. He'd watch stocks do exactly what he predicted, but he wasn't in the position anymore because he entered before confirmation. He eventually adopted a pivotal point system, refusing to touch a stock until it crossed specific price levels, with conviction. He wrote about the psychological difficulty of watching moves without participating, but he understood that the easy money was the dangerous money. His rule became ironclad: never anticipate, wait for confirmation, then act with conviction. The market will tell you when it's ready. Your job is to listen, not predict. Prediction is an ego game that makes you feel powerful. Listening is a humility game that requires submitting to price action reality, even when it contradicts your opinion. If you think a stock should break out, but it can't hold above resistance, your opinion is wrong. The market is right. But here's the catch that even disciplined traders miss. Confirmation alone isn't enough. You can have a stock break resistance cleanly, close above the level with strong volume, and hold for multiple sessions, and it can still become a perfectly executed disaster. Because price action is only half the story. There's a second red flag hiding in plain sight on every chart that can turn a technically perfect setup into a death trap, and most traders completely ignore it until it's too late. Imagine standing on a mountain road watching a car charge up a steep hill. The vehicle is moving fast, gaining altitude with impressive speed. From your vantage point, it looks powerful, unstoppable. But then you notice something crucial that changes everything. The driver's foot isn't on the gas pedal. The engine is silent. The car is simply coasting on leftover momentum from the downhill stretch it just completed. You know exactly what happens next. Physics takes over. Gravity reasserts itself. The car slows, stalls, and begins rolling backward down the hill, picking up dangerous speed in the wrong direction. In trading, price is the car. Volume is the gas pedal. When you see strong price movement without corresponding volume, you're watching a vehicle coast on fumes. It might look impressive for a moment, but market physics guarantee it will reverse. This is red flag number 2, strong price movement on weak volume. The volume mirage. It's one of the most seductive traps in all of technical analysis, because everything your pattern recognition system has been trained to spot is flashing green. The breakout looks clean. The candles are big and bullish. Resistance is broken. But underneath the surface spectacle, there's nothing supporting the move. You've lived this scenario dozens of times without consciously recognizing the pattern. A stock breaks out of a consolidation base, moving from 32 in a single session. The amateur sees that fat green candle on his screen and his brain floods with excitement. This is it. The breakout is happening. I need to get in before it runs away from me. He clicks buy immediately, entering at 32.10, congratulating himself for catching the move early. The professional sees the identical chart, but his eyes immediately drop to the volume bars at the bottom of the screen. He sees 150,000 shares traded that day. He pulls up the stock's 20-day average volume, 320,000 shares. This explosive breakout happened on less than half the normal daily participation. He doesn't feel excitement. He feels suspicion. He closes the chart and walks away without placing an order. Why such radically different reactions to the same price action? Because the amateur is trained to chase price movement. The professional is trained to judge conviction. And conviction doesn't show up in pretty green candles. It shows up in volume. Volume is the market's lie detector. Every trading day, billions of dollars flow through stocks, bonds, futures, and currencies. Most of that capital doesn't come from retail traders like you. It comes from institutions, pension funds managing hundreds of billions, hedge funds with sophisticated algorithms, mutual funds deploying massive asset bases, sovereign wealth funds, insurance companies. These entities don't buy a few hundred shares and hope for the best. They accumulate millions of shares over weeks or months. When the real money decides to move, they can't hide. They're like elephants trying to sneak through fresh snow. No matter how careful they are, they leave deep, unmistakable footprints. Those footprints are volume spikes. Heavy, sustained, undeniable volume that shows up clearly on every chart. If a stock rips from 32 32, but volume is light, or just average. What does that actually tell you? It tells you the move is being driven by smaller players, retail momentum chasers, short covering, random speculation, maybe some algorithms running basic trend following strategies. What it doesn't show is heavy, sustained demand from institutions who have the firepower to push your stock from 32.2, 37, 40 or 45. Without those big players providing fuel, who's going to sustain the upward move? Other small traders? They don't have the capital. So the breakout you're buying is exactly like that car on the hill, impressive for a moment, but destined to stall and reverse once the initial momentum fades. Let's examine the anatomy of this failure through a concrete example. Stock size has been consolidating between 28 and 30 for 6 weeks. The 30 resistance level has been tested 4 times and rejected each time. Every trader watching this stock knows 30 is the line in the sand. On a quiet Tuesday morning, Exes finally breaks above 30, climbing to 37.5 by midday. The amateur sees the breakout, notices it's holding above the key level, and buys it 30.25, thinking he's being disciplined by waiting for some confirmation. But he missed the critical detail. Volume was only 200,000 shares, well below the stock's 350,000 daily average. By Friday, Egg's eyes has drifted back to 29.50. The following week it's trading at 29. The breakout completely failed. The amateur is stopped out for a loss, confused about what went wrong. It broke out cleanly. It held for hours. I followed the textbook. 2 weeks later, Ziz approaches 30 again. This time when it breaks through, something fundamental is different. Volume explodes to 1.2 million shares, more than triple the daily average. The professional trader, who ignored the first breakout entirely, now pays attention. He watches Ziz close at 30.40 on that massive volume surge. The next day it opens at 30.50 and holds firm. He enters at 30.5. Over the next month, Egg's eyes runs to 37. The professional captures a 20% gain on a single trade. The amateur, still nursing his loss from the failed breakout, watches from the sidelines, convinced the market is somehow rigged against small traders. But the market wasn't rigged. It was speaking clearly in a language the amateur hadn't learned to read. Volume is the language of institutional money. When you see a breakout accompanied by massive volume, you're witnessing evidence that smart money has made a decision. They're voting with billions of dollars. When you see a breakout on weak volume, you're watching retail traders vote with thousands, hoping other retail traders will chase them higher. One scenario is a stampede of elephants. The other is a gathering of mice pretending to be elephants. Here's the professional's systematic protocol for filtering out volume mirages before they trap you. Step 1. Before entering any breakout, check the stock's 20-day average volume. This gives you the baseline for what normal participation looks like for that specific stock. Step 2. Compare the breakout day's volume to that average. Demand at least 150% of average volume as your minimum threshold for confirmation. If a stock normally trades 500,000 shares daily, you want to see at least 750,000 on the breakout day. Step 3. For high conviction entries, look for 200% or more of average volume. When you see 2 to 3 times normal volume accompanying a breakout, you have strong evidence of institutional accumulation. This is where follow-through probability increases dramatically. Step 4. Monitor how volume behaves after the initial breakout. If the stock continues trading on elevated volume as it advances, the trend has institutional backing. If volume immediately drops back to average after the breakout, you're likely watching a failed move in progress. There's an advanced concept here that separates true professionals from merely disciplined amateurs. Sometimes you'll see a stock spike dramatically higher on enormous volume after a long uptrend. That can signal a blow off top, where the last buyers pile in while smart money distributes to them. In those moments, massive volume isn't confirmation, it's a warning to take profits or stay away. Jesse Livermore understood this principle long before modern charting tools existed. He read the tape in real time, watching not just price changes, but the intensity and persistence of orders flowing through. He knew that a stock ticking higher on scattered buying was weak, regardless of the price rise. But a stock absorbing huge institutional orders while holding firm was dangerous to bet against. In his language, that meant strong hands were taking control. Volume is truth, price without volume is rumor. A rumor might push a stock higher for an hour or a day, but only truth can sustain a trend for weeks and months. Price is the advertisement, telling you what might happen. Volume is the contract telling you what's actually happening behind the scenes. When you combine red flag number 1, waiting for price confirmation, with red flag number 2, demanding volume confirmation, you eliminate roughly 70% of the losing trades that drain the average account. You stop chasing ghosts. You stop buying hollow breakouts. You start trading in alignment with the forces that actually control market direction. But here's the harsh reality that even experienced traders discover too late. You can find the perfect setup with clean price confirmation and massive institutional volume. You can enter at the exact right moment with all systems green. And you can still lose everything on that single trade if you ignore the third red flag. It's more subtle than price action or volume bars because it doesn't live on the chart at all. It lives in the space between your entry price and the point where you admit you're wrong. Most traders think they have this covered, but when price starts moving against them, they discover they never actually had a plan. They had hope. And hope is not a stop loss. You've done everything right so far. You found a stock breaking out of a multi-week consolidation with clean price action. You waited for confirmation as it held above resistance for multiple sessions. You verified institutional participation with volume running at 3 times the daily average. Every technical signal is perfectly aligned. Your cursor hovers over the buy button, ready to execute what looks like a textbook trade. This is the exact moment where the amateur and professional part ways forever. The amateur is thinking, how much can I make if this runs to my target? He's already calculating profits, visualizing the green in his account, planning what he'll do with the gains. The professional is thinking something completely different. Where's the exact price that proves I am definitively wrong? Not approximately wrong. Not probably wrong. Definitively, objectively, undeniably wrong. This brings us to red flag number 3, the phantom stop loss. If you cannot point to a specific price level and say, if the market trades here, my thesis is invalidated and I must exit immediately, then you don't have a trade. You have naked exposure. You have hope dressed up as analysis. You have a recipe for the kind of loss that doesn't just damage your account, it destroys your psychology for months. Watch the amateur's death spiral unfold in devastating detail. He enters the breakout at 40.50, excited about the setup. Someone asks where his stop is. He responds with the 3 most dangerous words in trading. I'll see how it goes. That sentence just sealed his financial fate. The stock opens the next day and immediately starts drifting lower. By midday, it's trading at 40.0. He tells himself it's just normal consolidation after the breakout. Smart money is shaking out weak hands. This is healthy price action. By the close, it's at 39.50. He's down about 2.5%. The discomfort starts, but it's manageable. It could bounce tomorrow. It doesn't bounce. The next morning, it gaps down to 39.0 and continues grinding lower to 38.50. He's now down roughly 5%. This is where the psychological trap springs shut. The loss has grown large enough that taking it feels genuinely painful, but not so large that he's forced into action. He enters the bargaining phase if it just gets back to 40. I'll break even and get out. The stock has become personal. He's no longer trading a setup, he's nursing a wound. Days pass. The bleeding continues. 38.0, 37.50, 36.50. He's down 10%. The loss is now so substantial that he's completely paralyzed. Taking a 10% hit on a single trade feels catastrophic. His brain starts manufacturing justifications. Maybe this is just a deep retest before the real move. Maybe institutions are accumulating at these lower levels. He's entered full hope mode, completely detached from any rational analysis of what the chart is actually telling him. Finally, after 2 weeks of psychological torture, the stock gaps down to 35.0 on negative news. The pain becomes unbearable. He capitulates and exits at 35.0, locking in a devastating 13.6% loss. But the damage goes far beyond the money. To get back to break even, he now needs a 15.6% gain on his remaining capital. He's emotionally shattered, confidence destroyed, and has no idea when he'll be able to trust himself to enter another trade. Now watch the professional trader navigate the identical scenario with completely different results. He enters the same breakout at 40.50. But before he clicked buy, he studied the chart structure and identified his invalidation point, 39 Ho, just below the breakout level where the stock had reclaimed. 40 Ho is support. That's his line in the sand. If price falls below 39, the breakout has failed, and his thesis is wrong. He calculates his risk per share. 40.50 entry minus 39 Ho stop equals 1.50 risk per share. He has a 50,000 account and follows strict risk management principles. Maximum 1% risk per trade, which equals 500. He divides 500 by 1.50 to determine his position size, 333 shares. He enters 333 shares at 40.50 and immediately places a stop-loss order at 39.00. When the stock drifts lower over the following days, he feels nothing. It's within his calculated risk parameters. When it finally hits 39.00, his stop triggers automatically. He's out with a loss of exactly 1.50 per share times 333 shares, which equals 499.50, almost exactly 1% of his account. He closes his platform, reviews what happened, and moves on to find the next setup. The difference in outcomes is staggering. The amateur lost 13.6% on a single trade and is psychologically damaged. The professional lost 1% and is completely fine. 2 weeks later, while the amateur is still paralyzed by fear, the professional finds another high-probability setup and captures an 8% gain. His account is now up 7% from where he started. The amateur is still sitting on the sidelines, afraid to pull the trigger, nursing a wound that will take months to heal. But the math is only part of the story. The deeper issue is what happens to your decision-making process when you trade without predefined stops. Every moment you hold a losing position without a clear exit plan, you're making a new decision to stay in the trade under increasing emotional duress. Your judgment becomes progressively more compromised as the loss grows larger and the pain intensifies. When you enter with a predefined stop, you make one decision in a calm, rational state. I will exit at this price if I'm wrong. Then you let the market tell you whether you're right or wrong. You've removed emotion from the exit equation entirely. The stop isn't a suggestion or a guideline. It's a contract you've made with yourself before your judgment became clouded by fear and hope. Here's the professional's complete protocol for implementing stops that actually protect you. Step 1. Before entering any trade, identify the logical stop level based on chart structure. For breakouts, this is typically just below the breakout point or the most recent swing low. For trend trades, it might be below a rising support line or key moving average. The critical requirement is that the stop must be based on technical invalidation, not arbitrary percentages or comfort levels. Step 2. Calculate your risk per share by subtracting the stop price from your entry price. If you're entering at 40.50 with a stop at 39.00, your risk is 1.50 per share. This is your hard number, no rounding, no estimates. Step 3. Determine your maximum account risk for this trade. Conservative professionals risk 1% per trade. More aggressive traders might risk 2%, but never more. If your account is 50,000 and you're risking 1%, your maximum allowable loss is 500. Step 4. Calculate position size by dividing maximum account risk by risk per share. In our example, 500 divided by 1.50 equals 333 shares. That's your exact position size, not 300 because it's round, not 500 because you're feeling confident. Exactly 333 shares based on mathematical risk management. Step 5. If you cannot identify a clear, logical stop level based on chart structure, don't take the trade. If the nearest structural stop is so far away that proper position sizing would result in a position too small to be meaningful after commissions, don't take the trade. The setup might look perfect, but if you can't define risk clearly, you have no business putting capital at risk. Jesse Livermore, despite his legendary tape-reading ability, went bankrupt multiple times because he violated this specific principle. In his later years, he wrote extensively about the critical importance of the stop-loss, calling it his insurance policy against ruin. He famously observed that the first loss is usually the smallest loss, and that refusing to take small losses early turns manageable setbacks into account-destroying catastrophes. The amateur thinks a stop-loss is admitting defeat, a sign of weakness, a failure of conviction in his analysis. The professional knows a stop-loss is a survival tool, a capital preservation mechanism, and proof of disciplined thinking. The stop isn't there to protect your ego. It's there to protect your ability to trade tomorrow, next week, and next year. Every legendary trader you've ever heard of, Livermore, Druckenmiller, Tudor Jones, Kovner, has the same relationship with losses. They cut them immediately and without hesitation. They understand that protecting capital is infinitely more important than being right on any single trade. They know that one trade means nothing. What matters is the cumulative result of hundreds of trades executed over years with consistent discipline. If you don't know where you're wrong, you don't know where you are. That maxim sounds philosophical, but it's intensely practical. Your stop-loss defines the boundaries of your trade. It tells you exactly how much you're risking to find out if your analysis is correct. Without that boundary, you're not trading. You're gambling with undefined risk in a market that can stay irrational longer than you can stay solvent. You now understand the 3 external red flags that destroy accounts: entering without confirmation, ignoring volume signals, and trading without predefined stops. If you master these 3 filters, you're ahead of 90% of market participants. You have a systematic approach that eliminates most losing trades before they happen. But there's one final red flag that's more dangerous than all the others combined. It doesn't appear on your charts. It doesn't show up in volume bars or price patterns. It lives entirely in your head, in your emotional state, in the space between market stimulus and your response. This invisible saboteur can override every technical rule you've learned, cancel every stop you've set, and justify every reckless decision that destroys accounts. It's the red flag that waits for you to master the technicals, then whispers in your ear at exactly the wrong moment, convincing you that this time is different. This is the red flag that destroys more accounts than all the others combined. It's the invisible killer that doesn't announce itself with flashing indicators or screaming volume bars. You can master every chart pattern, memorize every technical setup, and calculate risk ratios with mathematical precision, but if you ignore this final warning sign, none of it matters. The market will find your emotional weakness and exploit it with ruthless efficiency. Red flag number 4 lives entirely in your head, trading your emotions instead of the tape. The moment your decision to enter a trade is driven by what you feel rather than what you see, you've stopped being a trader and become a gambler. You've opened the casino doors and volunteered to be the house's next victim. The shift happens so subtly that most traders never see it coming. You've had 3 losing trades in a row over the past week. Each loss was small, technically managed, within your risk parameters. You did everything right, but you're down 6%, and that familiar tightness builds in your chest. The losses feel personal. There's a voice whispering that you need to make that money back immediately, that you can't end the week in the red. You open your platform Monday morning with different energy than usual. You're not scanning for high-probability setups anymore. You're hunting for anything that might recover your losses quickly. Your standards have dropped without conscious decision. Then you spot it, a stock breaking out of consolidation. You pull up the chart and everything screams caution. Volume is only marginally above average, not the 200% surge you normally demand. The natural stop sits uncomfortably wide. Under normal circumstances, you'd pass without hesitation. But you're not in normal circumstances. You're in revenge mode. That internal voice starts rationalizing. This could be the trade that turns everything around. I'm due for a winner. I can't keep sitting on the sidelines. Before you fully realize what's happening, you've not only entered the trade, but doubled your normal position size, because you need to recover faster. Let's watch this revenge scenario unfold with mathematical precision. You start the week with a 50,000 account. You normally risk 2% per trade, about. 1,000. Trade 1 loses 2%. Trade 2 loses 2%. Trade 3, a sloppy mistake, drops another 2%. You're down 6%. Sitting at 47,000. It stings, but it's manageable. Instead of stepping back, you feel the burn of needing to get back what the market took from you. You spot that marginal breakout and convince yourself that doubling your position size will let you recover in one shot. You enter at 42.50 with 1,000 shares instead of your normal 500. You've just violated your position sizing rules because desperation convinced you this trade has to work. The stock ticks up briefly to 42.80, giving you a momentary rush of validation. Then reality hits. By end of day, it's at 41.50. You're down 1,000 on the oversized position. The next morning, it gaps down to 49, keeps falling. Your wide stop at 39 finally triggers. You're out with a 350 per share loss on 1,000 shares. That's 3,500, a devastating 7% hit to your remaining 47,000. In one emotionally driven trade, you've turned a manageable 6% drawdown into a catastrophic 13% hole. Your account now sits at 43,500. 2 months of disciplined gains evaporated in 48 hours. But the emotional trap doesn't only appear after losses. It can be even more dangerous after winning streaks. You string together 5 consecutive winners. Your equity curve looks like a staircase climbing toward the sky. You start believing you've cracked some secret code. The market stops feeling like an opponent and starts feeling like your personal ATM. Jesse Livermore knew this demon intimately. Some of his most devastating wipeouts came not after losing streaks, but after spectacular runs of success. He'd make millions, start believing he saw patterns others missed, then push harder with bigger size and looser rules. After making fortunes in the 1907 and 1929 crashes, overconfidence would seduce him into reckless trades that erased everything. He later admitted his greatest enemy was never the market itself, but his inability to control himself after big wins and big losses. Now watch the professional navigate identical circumstances with completely different results. After those same 3 losses totaling 6%, he feels the identical frustration and anger. The critical difference is recognition. He's trained himself to notice these emotional states as they arise, like a pilot monitoring instrument readings during turbulence. He closes his trading platform, not because he's giving up, but because he recognizes he's temporarily unfit to make objective decisions. He walks away from his desk, goes to the gym, takes a long walk, does anything except stare at charts while emotionally compromised. He knows from hard experience that trading while angry is like driving drunk. You might get lucky once, but the odds are catastrophically stacked against you. The next morning, after sleep and physical activity, he returns with emotional equilibrium restored. The anger has dissipated. He's no longer desperate to recover yesterday's losses. He scans his watch list and finds a genuinely high probability setup, confirmed breakout, massive volume at 250% of average, clear stop just 3% below entry. Most importantly, he feels completely neutral about it. He enters with normal position size, manages according to his rules, and captures a 5% gain. His account recovers to just 1% below where he started. More critically, his psychology remains intact. He's still confident in his process, still capable of executing the next trade without fear or hesitation. The professional's protocol for managing this invisible red flag requires brutal self-honesty. Before every single trade, he asks one question: am I calm and objective right now, or am I trading to feel something? If you're angry about previous losses, you're trading to feel vindicated. If you're euphoric about wins, you're trading to feel invincible. If you're anxious about missing moves, you're trading to feel included. Any emotional motivation disqualifies you immediately. Here's what makes emotional trading so insidious: it doesn't feel like emotion in the moment. Revenge feels like determination. Greed feels like opportunity recognition. Fear feels like prudent caution. Your emotional brain is incredibly skilled at disguising feelings as logic, making impulse feel like analysis. When you're compromised, you literally can't think clearly. Your brain shifts from the prefrontal cortex, the logical planning center, to the amygdala, the fight-or-flight response center. The tape tells you what to do. Your emotions tell you what not to do. When price action, volume, and structure align perfectly, the market is giving you objective signals. When you feel angry, desperate, euphoric, or bored, your emotions are warning you to stay away, regardless of what the charts show. The amateur thinks trading is about reading patterns and timing entries. The professional knows trading is about managing yourself, your emotions, your ego, your impulses, your psychological state. You now possess all 4 red flags: the external warnings that protect you from bad trades, lack of confirmation, weak volume, absent stop-loss structure, and the internal warning that's more dangerous than all others combined: emotional compromise that overrides your rational system. These 4 filters, applied consistently before every trade, will eliminate the vast majority of losses that destroy accounts. But knowledge without implementation is worthless. Understanding these red flags intellectually means nothing if you can't apply them in real time when money is on the line and emotions are running high. The final step is locking these 4 principles into a systematic checklist that runs automatically before you're allowed to click the buy button. A filter so ingrained it becomes your default mode of operation, protecting you when discipline feels impossible and the market is whispering its most seductive lies. You now possess something most traders spend years searching for and never find: an actual defense system. Not another indicator, not another pattern, not another secret setup. A filter. A survival mechanism that quietly removes you from the trades that would have destroyed your account, your confidence, and your future in markets. You hold the answer to why 87% of retail traders fail within 2 years. It wasn't bad luck. It wasn't market manipulation. It wasn't lack of intelligence. They walked past 4 red flags on their way to financial suicide, ignoring warnings that were flashing in plain sight. You now see those warnings. More importantly, you now know how to respond to them. 4 red flags. 4 non-negotiables. If even one appears, you walk away immediately. No exceptions. No rationalizations. No bargaining with the market. Because every blown-up account in history can be traced back to one moment someone decided the rules didn't apply to them this time. Here's your 4-flag survival system, structured as questions you'll ask before every single trade for the rest of your career. Red flag number 1. Confirmation. Has the stock actually broken the key level and held it for at least one full session, or am I buying what I hope will happen? If you're entering while price is approaching resistance, if you're buying the anticipation of a breakout, you're not trading the market. You're trading your prediction. That's gambling, not trading. If the level isn't clearly broken and defended by buyers, you stop. You don't scale in early. You don't test with small size. You stop completely. Red flag number 2, volume. Is volume at least 150% of the 20-day average, preferably 200% or more? Pull up those volume bars at the bottom of your chart. If price is screaming but volume is whispering, you're watching a mirage. Institutions aren't participating. There's no fuel for sustained movement. If the institutional footprints aren't there, neither should you be. The breakout might look beautiful on price alone. You still stop. Red flag number 3. Structural stop. Can I point to an exact price on this chart that proves I'm definitively wrong? Not around here, not roughly 3% down, but a clear technical invalidation level. If your exit plan is based on pain tolerance rather than chart structure, you don't have a stop, you have hope. Calculate your risk per share. Size your position so total loss equals maximum 1 to 2% of your account. If you can't find a clear structural stop that allows proper sizing, you have no trade. Red flag number 4. Emotional state. Am I completely calm and objective right now, or am I trading to feel something? This question overrides all others. If you're angry about previous losses, euphoric about recent wins, bored and seeking action, or desperate to make it back, you're emotionally compromised. Your judgment is impaired. Close your platform, walk away, come back tomorrow when you're neutral. Watch how this system works in practice through 2 contrasting scenarios. Scenario 1. All flags green. You spot a stock breaking out of consolidation. You run your checklist. Price broke resistance yesterday and held firm overnight. Confirmed. Volume was 2.1 million shares on a stock that normally trades 800,000, massive institutional participation. You identify the breakout level as your structural stop, calculate proper position size for 1% account risk. You scan your emotional state, completely neutral, no attachment to the outcome. All 4 flags green. You enter with conviction and proper size. Scenario 2. 1 red flag. Same setup, same perfect chart, but when you reach emotional state assessment, you realize you're still frustrated about the loss from 2 days ago. 1 red flag. The entire trade is disqualified. Technical perfection becomes irrelevant because you're compromised. You close the chart without entering, saving yourself from what would have become a revenge trade with oversized position and loose discipline. This reveals the fundamental identity transformation that changes everything. The amateur focuses on what he might gain. He sees potential profit and calculates how much money that represents. He thinks about what he could do with those gains. Opportunity feels scarce and urgent. Every passing setup feels like money left on the table. The professional focuses on what he might lose. He sees the same potential, but immediately calculates risk if wrong. He thinks about capital preservation and compound growth over years. He knows opportunity is abundant. The market opens tomorrow, next week, next year. But capital is finite. Every dollar lost requires more than a dollar gained to recover. Protecting what you have becomes infinitely more important than chasing what you might get. Your new trading discipline operates like this. Before every entry, pause for 20 seconds and run this 4-flag checklist consciously. Has price confirmed or am I front-running? Is volume shouting or just talking normally? Do I have clear structural stop within proper risk parameters? Am I emotionally neutral or trying to fix a feeling? Green on all 4. You have permission to trade with full position size. Red on even 1. You have no trade. Not a smaller position. Not a let's just try it trade. No trade at all. Walk away. Wait for the next clean opportunity. Some days this means 0 trades. Some weeks this means 1 trade. Some months, if market conditions are poor, 3 trades total. The amateur calls this missing opportunities. The professional calls this capital preservation. You're not being inactive, you're being selective. You're acting like a sniper waiting for the perfect shot, rather than a machine gunner spraying bullets and hoping something hits. Jesse Livermore spent decades learning this lesson through devastating losses that cost him multiple fortunes. He eventually understood that the money was made in the waiting, not the trading. He would sit for weeks watching a stock, doing absolutely nothing, while amateur traders churned in and out trying to catch every wiggle. When his exact conditions appeared, he struck with size and conviction. The rest of the time he preserved capital through patience. He said it best, "It was never my thinking that made the big money for me. It was always my sitting. The sitting. The waiting. The refusal to act until everything aligned perfectly. Price, volume, structure, and emotional state. The best trades announce themselves. They don't require hope, justification, or rationalization. They scream at you with clean breakouts, massive volume, clear stops, and your mind completely neutral. When all 4 elements align, the trade practically takes itself. You're not forcing anything. You're simply responding to objective market conditions that meet your criteria. Your job isn't to trade every day. Your job is to trade only when all 4 flags are green. This leads to the paradoxical maxim that will guide your entire career. The best trade is often the one you don't take. Every time you walk away from a setup with red flags present, you've made an invisible deposit into your account. You've preserved capital for the next A+ opportunity. You've maintained psychological equilibrium that allows clear thinking. You've proven you can follow process even when it feels uncomfortable. That discipline, repeated hundreds of times over years, is what separates the 13% who compound wealth from the 87% who donate their accounts to professionals. If you've mastered the art of filtering trades today, you've solved the first half of the professional trading equation. You know when to enter and, more critically, when to stay out. But knowing when to trade is only half the battle. The other half is knowing exactly how much to risk when you do take a trade. You can find perfect setups with all 4 flags green and still destroy your account if you size positions incorrectly. You can have 90% winners and go broke if you bet too much on the 10% that fail. Conversely, you can have 40% winners and build generational wealth if you understand the mathematics of position sizing and risk management. That's your next frontier. Position sizing for maximum gain with minimum risk, pyramiding into winners, and managing trades once you're in them to extract maximum profit while protecting your downside. Until then, your mission is crystal clear. Cut losses fast the moment your structural stop is hit. Wait for confirmation instead of anticipating moves. Respect volume as the truth teller of institutional participation. Define your stops before entering every trade. And always check your emotional state before clicking buy. Own your process with the same intensity amateurs chase profits. Print these 4 questions. Tape them to your monitor. Make them automatic. Because in trading, the ultimate paradox is this. When you truly own the process and follow it religiously, the profits have no choice but to follow. Not because markets reward good people, but because disciplined execution of high-probability setups, repeated consistently over time, is the only reliable path to compound wealth in financial markets. The choice is yours. You can join the 87% who chase action and excitement, or the 13% who chase excellence and discipline. Choose wisely. Your financial future depends on it.